All right. Thank you everyone for attending this month's market update webinar for November 2023. Let's hop into disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can see our website for additional disclosures, and throughout the webinar, you can submit Q&A questions using the button below. Let's hop into a quick bio for those that are new here. My name is Jeremy Eppley. I'm a certified financial planner, accredited investment fiduciary, accredited portfolio management advisor, and chartered retirement planning counselor. You can learn more about me on my LinkedIn. And Silverstone Financial is a fee-only fiduciary registered investment advisor. We provide comprehensive wealth management services, including financial planning, investment management, tax planning, estate planning, things of that nature. You can learn more about us on our website. So there were definitely a lot of things that happened this month, a lot of notable events, some more so political or geopolitical rather than economic. The big headline that we heard a lot about in myriad of different news articles and political active movements and such was the Hamas-Israel conflict war, the conflict in Gaza. Even though it's been in the headlines for quite a long time, and it will probably continue to do so since there isn't much end in sight for the conflict, unfortunately. From an economic perspective, which is what this webinar focuses on, it shouldn't have a material impact on the U.S. economy or most of your portfolios. The biggest impact that could be argued is potentially government spending, how that could have some impact in the future on deficits or other kinds of budgetary cuts to make up for it. And if you held defense stocks that produce materials used in war, there could be a material impact. But other than that, I would not expect it to affect your individual portfolios. But beyond the headlines of Hamas and Israel that we've been seeing quite a bit about, there have been other impacts that will definitely have some sort of material changes in your portfolio that will definitely have some sort of impact on whether it's going to be green for the month or red for the month. So the first one I want to talk about right off the top on the top of the line is inflation. The Federal Reserve, every single month we've been discussing how inflation has kind of flattened out. We've gotten to where I see us staying for the foreseeable future. We had gotten through a lot of the pandemic extremely high inflation rates, and now that those really high months of over 1% inflation for a month happened at least once are past. Now we're kind of seeing an interesting cycle where this is the month over month readings of 0.5%, then 0.2, and then 0.1, and then back to half, and then 0.4, and then 0.1, having this interesting cycle throughout the quarters of every 3 months, having a similar-ish pattern. But unfortunately, these past 2 months, we had 0.6 and 0.4, not the greatest. To have that 2% inflation target, we need to be down by this 0.2. So we're definitely having some high inflation, at least high relative to the Fed's target. There has been a lot of opinions made that the Federal Reserve should adjust its target to perhaps 3% inflation rather than 2%. But if you're asking my opinion on it, that I believe that's probably what their actual target is, but they're not going to say that to the markets. if they announce that they're abandoning the 2% target, a lot of impact could spiral through different parts of the economy, different parts of the banking system, different parts of the stock market, bond market. That is honestly, it's just unnecessary to say. It would come off as very dovish, being afraid to do rate hikes, which is something that Jerome Powell, the head of the Federal Reserve, and most of the committee that makes the decisions hasn't been open to doing. So I would expect that we'll continue seeing interest rates held high until inflation comes below the 3%, 2%, closer to the 2% target. But it's probably going to take over a year easily, because all this has to make its way through the system, and we have to have lower inflation than these month-over-month targets. This past month, we had 0.4 as our actual inflation rate, and the expectation was 0.3, so a little bit hot. And same thing for the annualized rate, which the expectation was 0.6, but we actually got 3.6, and we actually got 3.7. I apologize. So definitely still hotter than expected, not extremely so, but inflation is still here to stay, and it will definitely be a topic on our webinar for the foreseeable future. An interesting, different topic that is very far away from inflation. It was, I don't know if all of you saw, it was a lesser headline, was the Naples supervolcano and the potential that this supervolcano near the Italian city of Naples would erupt. And I definitely don't specialize in volcanoes or earthquakes or anything like that, so I have no input on expectations. But it was very interesting to read the article that had come up, and the potential impact of such a supervolcano actually going off, since the chance of it isn't zero. It's something. It could be high, it could be low, but it's definitely not zero. And if such a supervolcano erupted, of course there would be tragic human loss. But from an economic standpoint, there's speculation of you could have ash in the clouds for a long period of time. It could affect the climate. It could affect crop yields across Europe. It could affect, of course, travel if you have to ground planes for quite a bit of time. So since it was a material risk that I saw, I wanted to mention it, that it could affect portfolios if something as terrible as a supervolcano erupting actually happened. But fingers crossed it doesn't. Another more classic piece of finance news this month were updates on the UAW strikes, the United Auto Workers strikes. From my understanding, I'm not following it extremely closely, but they came to a deal with General Motors and GM that is a completed deal, but they still have pending offers, tentative offers, with Ford and Stellantis, the other two major U.S. Car manufacturers. And ideally, strikes are usually good for no one. The workers don't get paid, the companies can't produce product, and the consumers don't get their product, and eventually will likely have more expensive vehicles. So ideally, a deal is reached that everyone's happy with, and we'll be able to move on from it. But it's interesting to see that it started out with the Hollywood strikes, and now we're on to the UAW strikes. And I had mentioned last month the potential of future more strikes. I think I saw some pilot strikes and such, but I believe that's a more common area for strikes to happen. So I'll definitely bring up if I see any other major potentially stock or stock market impacting strikes coming up. But for now, it looks like this is the last major one that is still pending. Ideally, hopefully by next month, I'll say that they have come to an agreement that everyone's happy with. The last big news item was the update on spot Bitcoin ETFs. I've mentioned it a few times. For those that don't know what that is Bitcoin is a cryptocurrency, and there has been a long legal battle for over 2 years, over maybe 3 or 4 years now, to offer an exchange-traded fund. That's what ETF stands for, that directly holds Bitcoin. So currently, you can go on the stock market and buy an ETF that directly holds, say, gold, which is a commodity, metal. And many people want the ease of, instead of having to go through Coinbase or Binance or some sort of cryptocurrency exchange to be able to invest in Bitcoin. Many consumers just want to have an easy investment that they can hold in their Roth IRA, their 401k. 401k is unlikely to hold an ETF, but it's still possible in some cases to be able to buy in your brokerage account. So there's been a big push for a long time to have a spot Bitcoin ETF approved by the SEC. And the SEC has repeatedly rejected them, in my opinion, in an inappropriate manner, not necessarily in a way that was unprofessional, but rather it conflicted with other rulings and approvals they had done in the past. And so many companies that want to offer an ETF sued them, and it's been a legal battle. And I think a month ago, 2 months ago, the court sided with the issuers. So they struck down what the SEC was doing and required them to either amend their ruling or allow the ETFs to go through. And so right now it's bureaucracy, it's a lot of paperwork back and forth. It's still not official, but the expectation is in the coming months, a spot Bitcoin ETF will finally be available. And so I'll get to what happened in the markets in a few slides, but Bitcoin was up over 28% for the month, hugely. Like, it's a really impressive return for a single month. And for within an hour, there was actually a false, which is what the line is. There was a false report that a BlackRock Bitcoin ETF, which is the main, other than the Grayscale offering, is the main ETF that is expected, that it would be the biggest one most likely. And it was reported that it had been approved, which was incorrect. And within the hour, it had, Bitcoin itself had spiked up by 10% and then dropped by 10%. And these ETF approvals actually are a really big deal. It's not mania. After these ETFs are approved, these companies have to go out and actually buy the Bitcoin, because they need to hold the Bitcoin in the fund so that the fund is actually real. I can't just say that it holds Bitcoin but never buy it. So a lot of these investors were trying to front run, trying to get out ahead and buy the Bitcoin for these large institutions that have to buy billions of dollars of it. So it's really interesting to see how Bitcoin has been reacting. The rest of the crypto market, of course, is not as well known as Bitcoin. It hasn't been performing the same way, but it's interesting. And for those of you that are clients, we have many of you have small portions of Bitcoin future ETFs, which aren't the same thing as spot ETFs. They track them similarly, but there are more fees involved, and there's some potentially tracking errors. So personally, I would love to switch over to a spot Bitcoin ETF, but we'll have to see. And there's also a potential that the attractiveness of Bitcoin as investment will change after these ETFs are approved and funded, because for my thesis, a personal opinion, that Bitcoin has been an attractive investment simply because there's institutional interest, these ETFs that have to buy them eventually when they're approved. After they're funded, Bitcoin will have to have demand, on its own, instead of this institutional pent-up interest that has been waiting for years to buy it. So we might have to revisit, or at least I might have to revisit my opinions of Bitcoin in the future if the ETFs get approved. Maybe, say in 2 months, maybe 6 months from now, Bitcoin isn't as attractive as it is currently. With all that said, not necessarily recommending for or against you specifically to buy or sell Bitcoin, just general commentary on cryptocurrencies. Moving on from quite a long recap of notable events, the Federal Reserve met today, 2:30. They had their conference. They had announced that they did no rate hikes. It's the first double pause since they began their rate hike cycle. So September, no rate hikes. November, today, no rate hikes. And they said that going forward, still they're going to make their decisions meeting by meeting. So we might get another decision in December that'll be no additional rate hikes. We might get a decision in December that they're going to do an extra 25 basis points. We will see. There's no guarantee either way, but we kind of have gotten to the point where we expected them to be, where they're holding rates flat. They're waiting to see how the economy reacts. Ideally, inflation comes down lower, and we don't have recession. We don't have large layoffs, and currently it's looking okay. Today, one of the notable things that Powell said was that he and the market committee has now taken off the expectation, or the serious worry at least, of a recession. They don't believe that a recession is going to happen anymore. Before, all the other meetings, the minutes of the meetings had revealed that there was, at least they're worried about a possibility. Now, again, these are just expectations by economists. The real economy will play out the way that it plays out. The economists don't have full control over it. But today the markets went up after the commentary saying, the Federal Reserve, the members of the Federal Reserve are at least positive on the economy, and that made a lot of money managers feel better about it. With that said, October itself, even though we just had the meeting today and they said some nice things, October was not a particularly good month, which was not what I expected. Last month, I expected that October would be a green month with some returns, and when we get to the chart slide where we show the graph of the S&P 500, I'll explain some reasoning behind it all. But quick recap, I want to point out mostly Tesla, NVIDIA, Google, Pfizer, Chevron, these companies, the ones that are very red, gave up quite a few gains. These are a lot of the mega cap names that ran a lot, mostly the tech names rather than the Pfizer, which is healthcare, and Exxon and Chevron, which are oil companies. But it was a lot of NVIDIA, Tesla. They were really high flyers in the beginning of the year. NVIDIA, I think, was up 100% or something like that in a few months, which was really, really significant. So these past 3 months, they've been giving up a lot of their gains that they had gotten, getting closer to normal levels, depending on how you value them. But that definitely had a drag on the markets. Interestingly, even though NVIDIA, Tesla, and such had pretty big drops, the mega caps performed better, which Tesla and NVIDIA are a large weighting in the mega caps, performed better than the S&P 500 or the small caps. There was quite a bit of selling, and a lot of these small caps, all the tiny squares in this heat map, a lot of them are red, and there was just a pullback. I don't have a reason for it, but from my understanding is there's a little bit more fear in the smaller companies, especially potential inflation, potential demand destruction. A lot of investors, a lot of money managers feel safer in the larger names that have stronger balance sheets, or at least potentially stronger balance sheets. There might be an argument to be made that small cap stocks have been oversold and there's extra value there that is being missed out on. I'm not here to make a commentary on that, but it's interesting to see how mega caps have continued to outperform, even though that a lot of them have sold off significantly in the past few months. It's very interesting. Talking quickly about global stocks, so non-U.S. stocks performing worse than the S&P 500, as they have throughout most of my webinars. I should point out the U.S. still has advantages to invest in rather than a lot of the international stocks, just strong dollar and a lot of other reasons, less geopolitics and wars going around in their neighborhood have caused a lot of U.S. companies to be seen as a safe haven, to be seen as a better investment than some international companies. And that's been true for the past 20 years. And personally, I expect international stocks to continue to underperform relative to the U.S. But each stock is different and each region is different, so it's no particular guarantee for your individual investments. But as a blanket commentary, they've been underperforming, and I'm not particularly surprised. Aggregate bonds lost about 1% this month. Been pretty flat this entire year, losing just a little bit every single month. This is actually 1%, 1.5% is on the worst side. Aggregate bonds historically in a single month don't lose that much. But in the grand scheme of things, it isn't like a huge fleeing from bonds, nothing to be too concerned about. The big winners were the alternative investments, these three at the bottom. Crude oil was down 10%, so not a big winner. But what was really interesting was usually when there's a war in the Middle East, oil prices go up because there's fear of supply constraints, that there's going to be destruction in either the production of it or the transportation of it. Oil was falling during the Israel-Hamas conflict, erupting. And again, I don't have a particular reason for that. It's just very interesting to see, and has, that's one of the reasons why Exxon, Chevron, some of the oil stocks underperformed, was because of the oil's price falling this past month. Honestly, I don't know where it's going in the future, but looking at the balance sheets of a lot of these oil companies, Exxon, Chevron, both announcing very large, multi-billion-dollar deals to acquire some of their smaller, some of their smaller company rivals. Both of them, Exxon having I think a $50 billion deal, and Chevron having maybe a $40 billion deal. Both very, very large mergers and acquisitions, which made a lot of people comment, a lot of analysts comment that they were saying, well, looks like they are doubling down on oil. They see a future for oil that, even though there's a shift to renewables, at least these large companies don't believe that they're in an existential threat, that oil is going to, consumption is going to be disappearing anytime soon. Because if you spend, dozens of billions of dollars on a company that produces oil, you expect in decades and decades of returns. So interesting to see how the energy companies see themselves internally, and the value there. For those of you that invest in oil stocks, I know we definitely have some clients that prefer to avoid oil stocks for environmental, ethical reasons. But for those that are heavily invested in oil, or just have an equal weight investment based off of their S&P 500 holdings or any other kind of holdings, oil is going to be interesting. And hopefully in the coming months, I'll have more to say about it, because I'm definitely intrigued about looking and researching a little bit more about the value there, and how the market is looking at these companies, especially with oil down and conflict up and investments happening. Very interesting, very interesting. But back to the two alternatives that did very well. Gold finally up 7% in a month. Throughout I think we're up to almost 20 webinars that I've done, and I've consistently said gold should be performing a little bit better. High inflation, usually gold is a hedge to that. I hadn't been performing particularly well. Well, this I think is the first month quite a big spike happened. 7% was more than it has. Usually it was up or down a couple percent, 3 or 4% at most. So gold definitely a winner, but the biggest winner, Bitcoin, almost 5 times what gold was doing, and that a lot had to do with the spot Bitcoin ETFs and such that I was talking about before. There's more frenzy in the crypto arena. And again, I don't know if that'll continue, especially after the ETFs are approved and funded, but currently it's interesting to watch. I think it's 35,000 per Bitcoin currently, which is pretty expensive. I'll fly through this really quickly. Year to date, similar as last month. 1 month change hasn't affected that much, but it's just a lot of the mega cap tech names just carrying all of the returns. You know, the Dow Jones is down a third of a percent, but the mega caps themselves are up 21% for the year, and that's almost all of the gains for the S&P 500. And if you break it out by just the tech names, I don't have the exact number, but I would guess that it's 8 or 9% of those gains, and the rest of the market is just losing returns for the S&P 500 index. Interesting to see. Small caps down 6%, still underperforming, but that has to do a lot with the banking stocks having a lot of struggles in the beginning of the year when there was the banking crisis and banks were failing and such. Global ex-US, so international stocks down 1.5%. US aggregate bonds down about the same, about 1.8%. But gold, crude oil up slightly, Bitcoin up over 100%, which is really, really interesting. 28% of that happening this month. But not those even compared to like Nvidia being up 180%, or Meta, which is Facebook, being up 150%. These are crazy large numbers for the year, and it'll be interesting to see if there's a pullback or a continuance of these runs into 2024. Honestly, I don't know. It depends on how fast the earnings continue to grow. That was one of the winning reasons that Nvidia has been winning, was because they had some really strong quarters at the beginning of the year. So I've been showing you this little graphic for a while. Last month I had added the inside part of the circle. So for those of you that don't understand how to read this, the outside is showing the historical average returns per month. It kind of helps you understand that the market is historically cyclical, seasonal. It performs really well usually at the end of the year. It has an acceptable and all right first half of the year, and then this third quarter is historically the worst. The inside shows what actually has happened so far this year. So it's actually been following trends pretty strongly, up, and then this is usually a coin toss. So it was down this year, and then up. This May was flat, and that's what we had, flat. June was an upset. We had a really strong June. Historically, June, you lose some money. July, about what you'd expect. And then August, September, what you usually expect is to lose money. But this October, another upset. How I mentioned, one of the reasons that I had called last month that I was expecting that there'd be a recovery this month was because of the historical seasonality of it. Now, it's important. This is a good example that seasonality is not a guarantee. This is averages over 70 years or something like that. So there is definitely a sway, a natural pull in one direction or the other, depending on what the month normally does. But it can definitely go either direction. And this month, there was a little bit of a sell-off. We had a loss of 2.2% in the S&P 500 rather than almost usually a 1% return. I'll get more into it in the next slide, but I do still expect the year-end rally. I think they're, from a technical standpoint, so what the markets look like on a chart, which is what the technicals of the stock market is, it is leaning in favor of a rally until the end of the year, and there's a good chance of it. But again, can't guarantee any of this. And what I recommend to clients and for just about for most people, to remember to invest for the long term, stick with it. Don't worry too much about the fluctuations. I know I have a whole webinar series about telling you what happened in the market in the past month, but it's ideally to help educate and reduce the fear by not knowing, rather than trying to encourage people to time the market or stock pick or move and try to beat it somehow. It's more so hopefully you get an educational sense of it rather than some sort of fear factor or confidence boost to try to beat it. This is more so for, hey, understand the markets and don't try to time it. But with that said, hopefully, and I do hope and I do believe that the rest of the year, last 2 months, we'll have a nice little boost and recover some of the gains we've seen or some of the gains that we've lost over the past 3 months. So this is the last slide, as usual. It's no longer, you can't see a lot of it because it's been moved off the chart as time has gone on, but this was a range that I had put in place that had been, the stock market had been trading in for a while. It was between 3,800 and 4,200 for the S&P 500. And it was trading up and down for almost a year within that range. And in July, I started, all these arrows are my calls. So I'm starting to track what I actually said each month to see if I was right or not. And also it'll help highlight that even someone that watches the markets every single day, you can't guarantee any kind of knowledge of how the market's going to go. Just a quick recap, I have 5 of these on here, and 3 of the 5 I got correct, and 2 of the 5 I got incorrect. So I'm batting 60 or 600 or 60% right now. So it's okay, but it's important to know that everything I'm saying here, opinions, there's definitely a lot of market watching and some experience in there, but it's education, and hopefully it's not trying to encourage any kind of stock market timing. Back to the range that I was explaining. In June, we had reached the top of the range, and I was predicting that we're going to stay in that range for quite a bit of time. So a range is, you have a ceiling and a floor. So this would be the ceiling at 4,200, and the floor would be 3,800. And basically, this range is something where the market is a group of traders, and some want to sell and some want to buy. And as you get closer to the top of a range, there are more people that feel comfortable selling at that point. So when you get to the ceiling, the majority of people are feeling, well, I don't believe that I can get much more value out of this, so I'm going to sell. And there's a downward pressure that pushes you back into the range instead of trying to break out of it. Same thing when you get to the floor, so 3,800 in this example, when you're falling down, the majority of market participants are thinking, well, this is a deal, I want to buy it, and it pushes you back up into the range. Now, in June, we had reached the top of the range, and normally markets stay within a range, even if it's rising or anything like that. But we broke out, which is a good thing because we want the markets to go up. We broke out in June and had a really great June and July. And at this point, we had overbought, at least in my opinion. When we had broken out of the range, I had changed my opinion because when you break out of a range, the range no longer really has power or influence. It's kind of hard to explain, but has less influence over what will happen if it's no longer the daily expectation, because everyone can see the same charts, so everyone has a lot of the same opinions about it. So when we broke out of the range, I had changed my opinion that we would continue to go up. We did, and we got to the top, and I was saying, I think we probably overbought. We ran up very quickly, which again is really nice, but isn't necessarily sustainable. So we sold off slightly. And when we got to September, I had been talking about, well, the cyclicality, the seasonality of the markets, and September is historically a really bad month. So I expected we would sell off, which we did. And then this past month, so October, so last webinar, I had been talking about, well, historically, October is the beginning of the year-end rally, and that most likely we would start seeing a flattening and a beginning of that year-end run. And I was beginning for I was right at the first half of the month. And then I believe most of the sell-off actually had to do with the conflict in Israel. About the middle of the month was when a lot of the conflict erupted. And it caused some instability, some worries and such, even though, like I had mentioned at the beginning of the webinar, I don't think there's going to have much of a material impact on your stock market portfolio because it shouldn't impact a lot of the earnings of the companies in the S&P 500 or a lot of the earnings of the other fund or indexes that you're holding. So now that we had this sell-off in November, I'm thinking it's looking even more attractive based off of where the markets were and the value that these companies hold and can generate from their earnings potential. And on top of all that, like this shows historically November and December are the two strongest months in the year. So with all that said, we touched the ceiling here, which has now become a floor in its own kind of way. And I wouldn't be surprised if we have a rally. So that's my expectation for the coming month. Again, not a guarantee, but I'll definitely let you guys know next webinar if I was right or not, and if I get to be what, 4 out of 6, so 80%, or if I'll be 50-50 for my calls. Last month I had said that we'd probably get to 4,600 around for the end of the year, but because we had a tough October, I think it's still possible, but it's less likely since there's just that much further we have to go. So I wouldn't be surprised now. I'm revising it slightly that we'd probably be around 4,500, so down about 100 on the S&P 500 index for the end of the year. But all that being said, it's not a guarantee, but hopefully a lot of these expectations help calm some of the worries, especially those of you that watch your portfolios every day and worried about this month since it was falling and falling because of the wars and such. So I haven't seen any questions come in so far. I'll wait a couple minutes, but other than that, thank you so much for attending. Hopefully not seeing any Q&A questions means that I've answered them already and that you all feel super confident about the markets in your portfolio. But if you don't, you can always either ask a question here or email me directly. Happy to help with any kind of concern you have. So still not seeing anything, so I will wish you all a good night. Looking forward to seeing you next month, and hopefully my predictions are correct and we will have a nice green month that I can report to you and say, hey, our portfolios are up, and it'll be great. So have a great November, everybody.